Next topic. Let's discuss bull market complacency. So I'm old enough to have lived through the internet bubble, which had a massive spike in euphoria, but there was complacency for a long time. And then before the great financial crisis, there was definitely euphoria in real estate, complacency in the equity markets. And then, really, for the last 15 years, with the exception of the COVID drawdown and the drawdown in 22, there really hasn't been a bear market. How should investors be thinking about this bull market complacency? Austin, why don't you go first?
I think that after you've had a long run in markets, we tend to find a lot of people are complacent, expecting that the most recent experience is going to be extrapolated indefinitely into the future. That's not necessarily the way things work. While it is tempting to want to jump on, and this kind of gets to the lemming trade, where everyone wants to do the same thing and eventually they all run off the cliff and die. This happens a lot with investors where they don't die, but they significantly encumber their portfolio because they all chase the most recent exciting thing and they become complacent to the risks that could be embedded in that new exciting thing. And so right now, if you look at some of the indices, you can see some complacency there where you see a handful of names representing, a third or more of the index. A lot of people like to say like diversification is the only free lunch, and so you should buy the S&P 500. Well, newsflash right now, if you buy the S&P 500, you're not all that diversified because you own an overwhelming majority of a handful of names. And so I think that investors need to step back for a second and start thinking about what's actually going on in the market rather than getting all excited by the emotion that is just ricocheting back and forth with cable news and FinTwit or FinX, whatever you call it today. That's exciting, I would say tremendously positive emotions. And then the last couple of days, negative emotions. Instead of letting those emotions dictate your decision-making, just focus on facts.
Adam?
Yeah, look, I think it's really easy when there's not a cloud in the sky to assume that it's never going to rain again. And then you go out and you leave home and you don't take an umbrella. And guess what? At some point it will rain again. But people forget that. And it's a recency bias. It's you feel good because your investments have been doing well. And you sort of forget that there's this other direction things can go in. And it tends to happen quickly, right? Markets tend to kind of crawl upwards and then fall off a cliff to the downside, like a 10% drawdown in 3 trading days. I remember back in August 2011, I think it was, in something like 6 or 7 trading days, the S&P was down 20% with the European sovereign debt crisis and the U.S. getting down, credit getting downgraded. And those things happen from time to time. The irony is when there's not a cloud in the sky, insurance is the cheapest it's going to be. If you wait for it to start to rain and then you go try to buy, protection, it's like buying the condom after you've had sex. It's not going to help.
You got to take that out, Ken.